another Reserve Bank rate hike, now taking the cash rate above our forecast peak for 2023. What are the implications, and what will influence the RBA in the months ahead? The June hike to an official cash rate of 4.1% is now deeply in contractionary territory. And while the language from the RBA hasn't markedly changed, their impatience to get the inflation rate back to target within a reasonable timeframe clearly risks the soft landing that was our preferred scenario, and further lifts the probability of a hard landing recession. As the chart shows, the 4% of rate hikes in 14 months isn't as aggressive a path as other comparable central banks have taken, but given the high share of variable rate mortgages here, will continue to steadily impact domestic demand, and recent retail sales, consumer sentiment and jobs data all point to higher rates starting to slow the economy down. We're still expected to have a lower peak in rates than elsewhere, but while the RBA again stated their aim to keep the economy on an even keel, a cash rate above 4% makes this outcome much less likely. The RBA decision was no doubt impacted by the recent uptick in inflation in the monthly series for April, although that increase was mainly due to base effects from the halving of the fuel excise tax in April 22. But their comment that while goods price inflation is slowing, services price inflation is still very high, tells us that the RBA board will maintain its tightening bias for some time. Our recent peak in inflation was at a lower level than comparable economies, although our decline since the peak is clearly not fast enough for the RBA. We still expect inflation to steadily fall to around 3.5% by year end. And while this latest hike will speed up the path to 3% in 2024, it will also see a faster rise in unemployment and underemployment. The unemployment rate rose to 3.7% in April, and we expect the jobless rate to be around 4.5% by year end, well above the RBA forecast of 4%, and at risk of a faster deterioration as the economy slows. The RBA forecast of unemployment not exceeding 4.5% through 2025 therefore appears very ambitious given the extent of policy tightening. GDP growth, currently around 2.5%, will continue to decelerate. Our soft landing scenario forecasts real growth of just 1% this year, but even this will be harder to achieve depending on where the cash rate ultimately peaks. From here, the key data points for the RBA are the next labour market report on June 15th, the monthly CPI on June 28th, and quarterly CPI out on July 26th, and developments in property markets after the recent uptick in CoreLogic house values, but fall in building approvals in April. The RBA will also be keeping a close eye on unit labour costs and on offshore developments. But even if this is the peak in official cash rates, relief via rate cuts remains well down the track. And lastly, the Aussie dollar is higher after the rate decision near 67 US cents, and news of further policy support in China for their property sector and via infrastructure investment may provide further support to commodity prices. Australia's trade surplus remains a strength, and offshore demand for our exports will be crucial to offset much slower domestic demand. And that's the market update from Leverage.